Introducing Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Ted Dixon, CEO and co-founder of IncResearch.ca, Canada's first online financial news and research service providing insider news and knowledge to investors. His website, CanadianInsider.com, home of the Canadian Insider Club. Welcome back to the show and best of the season, Ted.
Oh, well, welcome to all your listeners. Jim, for tuning in. I want to wish them all the best for the holidays. Merry Christmas, Happy New Year, and the same to you.
Now, the Fed just hiked its trend-setting rate. The Bank of Canada did the same earlier. Is this really going to slow things down going into the new year?
Well, it could. And what's, the Fed is really playing with fire here, and that's because, of the big pile of tinder that they set in the global economy over the past couple of years, and of course letting inflation, which they up until a year ago said was transitory, basically get out of control. So now Jerome Powell, very well connected former private equity banker, is saying that they've got to clobber the job market, i.e. put Americans out of work, many Americans out of work, to deal with this inflation problem that they basically were supposed to be on top of to begin with. So we have an unfortunate situation as we head into 2023 where you've got a central planning agency, the Federal Reserve, deciding that because of its own mistakes that it made, that it now has to basically throw Americans out of work. And this is the environment we're dealing with. So I wanted to highlight the Main Street impact of this before talking about the market impact, because sometimes, it's easy to, not easy, but, sometimes we kind of focus on what does this mean for the stock group or this, for the market. But when you've got a central agency targeting citizens to saying, no, you're being too successful, you're negotiating pay increases, we don't like that. I think that's really stunning, that's the U.S. Central Bank, but we have a similar situation going on in Canada. It's a little different in Canada in terms of how things have played out. In the past, the Bank of Canada has been juicing the housing market, and they've got that to deal with along with the inflation problem. But, in terms of how it's going to impact investors, it's what's going on in the United States. The United States is a reserve currency. The central bank, the Federal Reserve, decisions impact the reserve currency, so we all get affected. It's their currency, our problem, for the rest of the world. But in this case, it's also going to be the problem of Main Street in the U.S. Because you've got this organization that wants to increase the unemployment rate, which means, again, you people on talk business television was, Fed wants to increase the unemployment rate. Well, what does that mean? It means they want people to lose their jobs, right? And that's what we're talking about here. So when people lose their jobs, it doesn't help, of course, with earnings, right? Especially in the U.S., where with such a huge amount of the economy is geared towards consumption. Fewer people working means less consumption. So what we've had in the since the Fed meeting on Wednesday, the U.S. stock market is going, the Fed, it looks like they're really serious about killing the economy. We better knock down stock prices. Now, what was interesting, heading into the Fed meeting, the S&P 500, which of course was one of the investment vehicles of choice for the world. You can't invest in the S&P 500, but there were ETFs that track it. Passive indexing was all the rage, and it was toying with its 200-day moving average. Okay, will it go up or will it go down? Well, I think we have the answer. Right now, it's going down. And again, it's because of this reassessment of the economy. So the environment heading into 2023 has investors very worried. Okay, so this is, of course, spilling over to the economy-sensitive areas in Canada in mining and in energy. Let's leave energy aside for a moment because that's a special case that's got a lot more going on with it than the Fed. But when we look at what's happening, for example, in the mining area, again, it's this idea that, well, the Fed's going to clobber the economy. Okay, so yes, this is true. This is what they're saying. But let's look at the reality, which is sort of the counter. I guess what I would say is like the counter argument to this. The Fed is going to destroy everything. First of all, can the Fed really carry through on its threats to keep raising interest rates? And unfortunately, I believe that they will be constrained, not because of concerns about the job market. I think they're quite willing to throw Americans out on the street and increase the homelessness, and I think they're quite prepared to do that. But what they're not as prepared to do is have the U.S. Treasury market come unhinged, where there's a lot of illiquidity and sloppy bond. We had 2 sloppy bond auctions this week. Investors didn't seem too concerned about it, but if it keeps happening, we will see. And the U.S. government is going to be issuing more and more debt. They've in the first 6 months of the fiscal year, I believe the number is $1 trillion in debt. So the bond market has to be able to digest this. And the more the Fed raises rates, the less liquidity there is in the market and the less ability there is to buy these bonds. So that's where I think the big constraint is going to be, unfortunately. And I say unfortunately because, to me that's that's just my personal opinion, so it doesn't really matter. But, it's a shame that the financial markets are top of mind with the Fed compared to how their impacts are going to be on the citizens. Okay, so I don't think the bond market is going to let them. I could be wrong, but I think there's a risk there. Let's just say there's a risk that the bond market is going to have a moment where the Fed will have to, whether it likes to or not, and it may not admit it, but will have to step in and basically reverse course. Okay. The other aspect of it is that the job market remains strong. So it's going to be really hard for the Fed to kill it, I think. But if they're and I think this is part of the problem right now is that the market's saying, they really want to kill it and it's going to be strong, so they're really going to have to raise rates really high. So it's kind of set up for a battle royale, I guess, between the labor market and the Fed, but it's going to be a tough one for the Fed to beat. They're going to try, but I don't think the bond market's going to let them. So I think that's the counter, the immediate, sort of the 6 to 12 month counter argument to what markets are kind of worrying about today. And this is Thursday on the 15th of December. The other aspect, though, a bit more longer term, and we wrote about this on Monday, is that look, and we suggested, I don't know we expected, we suggested we wouldn't surprise if there's a sell-off either after the inflation numbers or the Fed meeting. Well, here's a sell-off. But when it comes to what governments want to do with the energy transition, this is not going away. The Fed does not have control over that. They do not have control over the Biden administration's Inflation Reduction Act push to, promote more EVs and electrification of the U.S. economy. They do not have control over China's push to electric vehicles. They don't have control over that, and those policies remain in place. So the fundamental case for industrial metals geared to the energy transition remains intact. However, that is more of a longer term a 5-year piece, and it's going to have to suffer this intra-period volatility here, where you've got the Fed making policy error after policy error, and that's just something we have to live with. Unfortunately, it's very painful, but that's just the nature of the system that we operate in, the centrally planned monetary system of the democratic countries. And until that changes, if it ever changes, that's what that's the market system we live with, and we have to worry about what these planners do in their meetings and their press releases and their press conferences, because they have a lot of power. And right now, the market is nervous. We'll see, though, in a few weeks after people come back from Christmas and New Year's, whether they're in a better frame of mind and believe which I do, we're closer to the end of this hiking cycle than the beginning, and that people should start factoring in, investors should start factoring in what comes next. And what comes next is a steadier state monetary policy. I don't necessarily agree with those in the market that say the Fed's going to be cutting rates, because again, I think the labor market is very strong in America, thank goodness. But just having the Fed not do anything for a while would be nice. And the fewer speeches too, the better. That would be also very nice. But that's their gig. They like to get out there and make speeches and get on TV and the like. And that's, I guess, to get that job, you got to have that kind of personality. And so we're going to probably have to put up with more of these spins from these central bankers. But if they could just steady the course instead of upsetting the apple cart every 9 or 10 months, that would be good. And I think the markets could handle very easily. Well, I don't say easily, but they could handle a steady period of higher rates. They just don't need the volatility associated with what comes next. And hopefully we're getting closer to that stabler environment in 2023. So that's the kind of the positive outlook I would have for 2023, that once we get through all this kind of this kind of conflict that the Fed is dealing with its inflation mistakes of the past, once they get to a point where either the market forces them to stop, or they stop because they feel that they've done enough. That will happen, I believe, in some point next year. The question is when and how we get there. And my bet would be that the bond market forces them to stop, but maybe not. Maybe it'll just be the Fed will decide, okay, we've done enough. We have to wait and see now what the implications are of all these rate hikes.
Have they already hiked too much? Because we had such low rates for so long. I don't think we needed much to make a difference, but what's your opinion?
Well, it's just an opinion which will only be borne out on, in hindsight. I think the rates were too low, so they had to move them up to a more reasonable level. When you have 8% inflation, you can't mess around. Like, I think they should have raised rates faster and earlier. That didn't happen. So now, where are they? Look, if you're behind the curve, you just have to hurry up and get to the end of the curve, so you're there. So I think we're probably at a more reasonable level of interest rates now, and I think the market can handle it if the Fed would just become a little bit more stable in its approach and a little bit more rules based, and they could probably handle. In terms of the job market, I can think of maybe one of the first places where they could probably reduce jobs would be in the Fed with all its economists. I don't think they need as many because they've done such a horrible job at planning and predicting events that clearly there's a problem in the Fed with its human capital. And if they can't do the job, why do they need as many? I mean, I hear there's like 200 economists. They probably need about, they could probably cut 90% of them, and the world would continue on just fine.
We'll have more with Ted Dixon right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ted Dixon. Ted, how did Canadian insiders do this year, and how do you think they're going to do next year?
Well, the year's not over, and as we wrote it, this is kind of it's turning up to be a make it or break it period for insiders and our Canadian Insider Index. Up until December 14th, it's done fairly well on including dividends. It's up 8%, 8.2%. We're getting some volatility here at the end of the year, so I don't want to. It's still 2 weeks too early to do any kind of declaration that it's been a decent year. But so far, up until this point, thanks to the bullishness of insiders in the energy area, our rules-based index, and it's based totally off of our Ink Edge signals that look at valuations, what we call insider commitment, as buying and holdings, and price momentum. It's done all right, up 8.2%. So, and that's compared to the, for example, the TSX Composite, which before dividends is 6.2%. So without dividends, the Canadian Insider Index is up 6.4. So you can compare that to the TSX, which is up down 6.3. So there's like more than a 12% difference. So it's been a good year for insiders. It's been a tough few months, especially the last month with the energy complex having its hits, and that's like I mentioned earlier. It's beyond the Fed. We've got, of course, we do have this cloud of potential recession, which is never good for the demand for energy products. But we've also had this kind of roller coaster of COVID policies in China, which I think have stabilized to some extent. In at least, we know they pivoted to a more, I'll use the word tolerant approach towards the Omicron variant as opposed to COVID-0. So they're going to accept more infections, more like we have here in North America. That's going to come with certain disruptions and risks, but I think it's in terms of the outlook for the economy there, it's probably better in that if you're not worried about lockdowns at any time, you're not worried about going to the store and not being shut in the store because there's a COVID case. That should be positive for the economy, and I believe that COVID-0 policy was set during in relation to the Delta and other variants. The Omicron variant is quite different, so it was probably right for the Chinese government to pivot. And but again, it's not going to be there's going to be some costs associated with that. So we'll have to see how it plays out. But that was a big overhang on the energy market, the COVID-0 policy in China, because it impacted the demand for fuel in China a lot. So that should be improving. So that should be positive for the energy market. But you had this nonsense with the G7 price cap, and I say nonsense because nobody really knew what it was going to be. And this was, for those who may not remember or who are not paying attention to this kind of geopolitical gamesmanship, the G7 had indicated that they were going to put a cap on Russian oil as of December 7th. The problem was they didn't say what the cap rate was, what that number would be up until like the weekend before, which is problematic in the oil market because it takes more than a day to ship oil from a terminal, to its destination. So there was a lot of inventory builds ahead of this cap, and a lot of that inventory then, came to the market here in December, as far as I understand it. And, so that hit the price and concerns over recession. So now we're working through that. We're seeing it bounce back, and then had the Keystone Pipeline leak, which hurt some Canadian producers. Part of that pipeline apparently has been restarted. Part of it will not be restarted. So there's a bit of fog there in terms of what it means for Canadian producers. I haven't seen any comment on it yet in terms of whether it's material or not. That may come out may come out in the early new year. We'll have to see. But yeah, there's all these moving parts in the energy sector which are been weighing on it. We've written a piece today highlighting there has been some insider buying in the energy sector on the dip, but there's also still some selling. So I think, the risks, the stock prices have adjusted to the risks now that make energy in some areas a little bit more attractive because the prices have fallen so much. But, I don't think we're yet at an all clear where the risks have been, mopped up to a huge extent. There's still uncertainty about the geopolitics. There's still uncertainty about U.S. policy, and of course this pipeline problem, and of course on natural gas. You've always got the uncertainty about the weather, but that's nothing new, and that shouldn't affect the longer term price trends. But it's always those weather forecasts always end up in the mix somewhere.
Are there any concerns in the Canadian energy market about Alberta's new premier?
I haven't detected anything, and I find that story is more of an interest to political pundits than market participants.
Can we get enough guys out to the wellhead to produce? That's the key question.
Well,
right?
Is the Keystone Pipeline working? How's that Trans Mountain extension expansion project going? Like I think those are the political issues, or regulatory public issues that are more concerning the oil patch than games than headlines out of between Ottawa and Edmonton on political stuff.
Ted, anything else we should be keeping a close eye on as we close out 2022? I want to say 1982 because we face the same kind of inflation.
Well, I think this. Watch what they do at the Fed and in their money markets, not what they say. Right now, today, the market is freaking out by what these central bankers are saying. We don't provide these services, but there are others that do. I'm not going to recommend any because it's more, I think, art. It's part art and science, but there are those in the market that follow liquidity, how insiders are, how public entities such as central banks are either adding or taking away liquidity. We do have a curated video stream on Canadian Insider from YouTube that's free that you can that people can look at, and sometimes there are experts that cover the liquidity situation. I would definitely pay attention to that in the new year because I think a lot of what's going on right now is the central banks are talking a tough game and they want people to believe that they're going to crush inflation, but they really want to do as little as possible from here. Like, they have raised rates, but from here because they're really worried about what happens in the bond market. We saw, I think, the warning signs were in the British market back in September when we had this problem in the gilts, when Liz Truss brought in a budget, and I know there was this spin saying, "Oh, it was all Liz Truss. It was all Liz Truss. She messed up." Well, I think what it basically shows is that any government tries to do anything aggressive on the growth side, there could be problems. So it's in the U.S. we have big deficits coming. They're baked in the cake. Defense spending. Social Security. There's a big Social Security raise for people this year, I believe, because it's tied to inflation. So I think the Social Security payments are going up about 8%. It's all going to impact the deficit. So watch what the central banks do more than what they say.
Ted, thank you so much for chatting with us.
Well, thanks for having me back, Jim.
My guest has been Ted Dixon, CEO and co-founder of inkresearch.ca, his website, CanadianInsider.com. If you have any questions for Ted or any of our guests, you can send them to info@HowStreet.com, our YouTube channel, Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.